My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make a little money. My job's not just to entertain, but to educate and teach. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Going in the right direction. I heard it all day. The consumer price index is no longer red hot, and it looks like the Fed is winning. It's going in the right direction. And that's why we could rally. Dow advancing 86 points, S&P gaining 0.74%, and the Nasdaq jumping 1.15%. And it's true. We had a surprisingly positive consumer price index number, even if that's more or less what everybody was expecting. A surprise that we expected. So, are we out of the woods then? Is the Fed done tightening, right? In your dreams, people. The Fed's not done, and I'm going to tell you why. First, going in the right direction is not what the Fed's aiming for. The only line in the CPI that made things truly better was the decline in used car prices. If it were suddenly to reverse and go up in price, then the CPI would be headed in the wrong direction. If the Fed were to change course based on a number that's heavily influenced by a single piece of data, they would have zero credibility. Second, the data that's most important when it comes to inflation right now, housing prices, isn't even in the consumer price index. Back in 1983, a group of politicians took the price of homes out of the index in order to make that inflationary moment look, well, less inflationary. Unfortunately, home price escalation is now the single worst form of inflation out there.
The house of pain.
Home prices are up a staggering 40% since 2019. It's routine now for Toll Brothers to sell million-dollar homes and have bidding wars over them. I think it's safe to say that at this pace, the American dream of owning a home will be borderline impossible for the vast majority of people in this country because of inflation. If you remember the Federal Reserve, this is completely unacceptable. Home prices must be rolled back, not just less inflation. They want deflation. The difficulty for the Fed is that there's a huge gap between the number of homes being built and the number needed, perhaps as many as 4 to 5 million. And there's very little existing supply because interest rates were kept so low for so long that people don't want to sell and move somewhere else where they have a much more expensive mortgage. So the Fed has to play for time until more homes can be built and more apartments can come online. That's higher for longer. Third, we need to stop confusing any given index with the tight labor market that makes our current bout of inflation so intractable. There are still way too many jobs chasing far too few employees. There are still more businesses that are expanding rather than contracting. Even after the mini banking crisis, incredibly, there's plenty of capital and credit available to start a new business. And let me tell you what I'm really worried about. The gigantic number of jobs that are being created all over the country to meet the demand generated by all the federal government money earmarked to stop climate change or to build our own semiconductors in this country to get away from the chokehold of Taiwan. Both worthy goals, both goals I champion. But the timing couldn't be worse. This morning, I was going through the jobs that are needed in the battery industry, the solar industry, the wind industry, and the semiconductor manufacturing industry. I then layered on the biggest building projects in our nation, like the liquefied natural gas export plants that have made us the world's biggest exporter of the stuff. I can tell you that there are literally hundreds of thousands of jobs that are being created right now. Hundreds of thousands. Now, that would be terrific if we're in the middle of a recession or even just a stagnant economy. All these projects could take, say, a 6% unemployment rate, bring it down to 4%. But a 3.6% unemployment rate like we have, this is nuts. We have no real existing slack of trained workers who know how to work with their hands, who know their way around factories, who can do spot welding or handle heavy machinery. The people currently being laid off in this country are either top-of-the-line white-collar workers at tech companies or cashiers at failing retailers. And there aren't too many of those, almost all of which seem to be connected with Bed Bath & Beyond, like Harmon Face Values, Bye Bye Baby, or the previously owned Christmas tree shops. Worse, the kinds of jobs that are being created are really so specialized, it's almost impossible to believe that there are more than a handful of people who really know how to do them. During the heyday of Intel, there was a core group of engineers who understood how to put up semiconductor fabs, and Intel was the best of the best back then. Now our country's going to be putting up fabs in places all at once, where there's very little institutional knowledge of how to construct these complex factories. Companies that are building them in Ohio and New York will be very hard-pressed to find the right people to do the job, to find any people to do the job. But that's nothing next to the talent that will be needed to build all the battery plants for electric vehicles, let alone the skilled workers who know how to operate these plants. I have no idea how those will ever be staffed. The solar and wind projects are so voluminous, you have to believe the few companies that build these things will be bidding against each other for talent. And that's how limited the knowledge pool is. Again, I am not against any of these projects. I was a huge supporter of the CHIPS Act, probably the first one, because we currently source the bulk of our semis from Taiwan, a country with disputed sovereignty that the People's Republic of China always seems eager to invade. We have no sizable troop presence there to stop them. The hope is they wouldn't do something crazy like invade a U.S. ally because it might trigger World War III. But maybe they figure we're bluffing. It's vital that we have our own semiconductor manufacturing capacity, but not just for industrial purposes, but for military might. I'm also a big fan of using clean energy, not dirty energy. Solar, wind, electric vehicle charging. These are all integral to cleaner skies. I want to continue to export natural gas into the global market because it's much cleaner than coal. But we sometimes seem to forget that we now have an economy based on services, not manufacturing. People, this is not 1950. It's 2023. And our economy is about 70% based on services. Even in recessionary times, we wouldn't have a pool of skilled labor that's big enough to handle all these projects. We don't have the schools that can train people either. Our country got out of huge manufacturing after NAFTA and ceded a ton of manufacturing to China. It's part of a desire to have cheaper goods for people to wear and furnish homes. It was a corrupt bargain in retrospect. So if you're the Fed, you can be joyous that the price of cookies has come down, and fish seems to have stabilized, apparel is cooling off, and secondhand cars are going in the right direction. But the number of jobs being created right now by federal money is so gigantic that it's almost impossible to imagine where we'll find people to fill these positions, at least at these prices, if not much, much higher. I can tell you this, though, they're going to be paid a heck of a lot more than anyone expects, and I wouldn't be surprised if the general contractors don't even hazard to bid for these jobs because they'll lose too much money. Bottom line, unfortunately, even with inflation cooling, the Fed has no choice but to keep tightening, if only to offset the tidal wave of inflation caused by all the government spending that's about to steamroll this economy. Scott in Pennsylvania. Scott.
Hey, thanks for taking my call, Jim. I heard your comments yesterday on shorting in the market. And
yeah. People talked about that Carvana piece. All over town, they talked about that Carvana. A lot of people said, why do you do that piece? Well, I got more comments on that Carvana piece than I had in a long time. What's going on?
So I remember the Bear Stearns story where they were concerned about being shorted and looking to be crushed. And this morning I was looking at Newell, NWL, and noticed that they're 6% short. But they recently just started increasing in their price. So do you think they're in play?
No, I think that they've actually got management that's turning things around. But the balance sheet is not what it should be. And any company that has a not great balance sheet is, in this environment, going to, if we're thinking we're going to recession, attract short sellers. I don't care for the company, in part because I still think they have a lot more to do with the balance sheet. But it is better than it was a year ago. Let's go to John in North Carolina. John.
Jim, many thanks for your investing help over the years.
Thank you, John. Appreciate it. What's up?
Several weeks ago, a short sellers report knocked down Exponential Fitness. What do you think of that one moving
Holy
forward?
cow. I was talking to Ben Stoto, who is our research director, and I said, we got to get these guys on. This thing was just a solid raid. Exponential Fitness, listen up. Welcome back to the show. We need you more than ever. Okay, even with inflation cooling, the Fed has no choice but to keep tightening, if only to offset the inflationary impact of all the government spending that's about to hit this economy. It's been underestimated by everyone. Oh, man, tonight, remember the IPO class of 2021? Well, there are some higher quality members that are making a comeback, and I'm talking to one of them. It's called Sprinkler, fresh off the company's investor day to learn more about the story. Then we're continuing our series on spending related to legislation, this time digging into the Inflation Reduction Act to see how you could profit off the new flow of money. And DocuSign is the new CEO at the helm. So could this be the catalyst the stock needs to finally move higher? I'm talking to the man himself. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.